Welcome back, ladies and gentlemen. When this decade started, there was an ample belief that it's a golden decade for India, as many meaningful reforms were executed in the last decade. But then, before the decade could begin, world was hit with the pandemic. It took 2 years away from this decade, and now, when everything is back to normal, US is hit with recessionary fears on one side and inflationary fears on the other. This in turn does impact Indian economy and markets as well. So, despite attractive demographics, stable government, so many reforms, will India have to still wait for expected golden decade? This question is being now asked by many thinkers and is being all the more raised as FIIs are constantly selling Indian equities. To get views and perspectives from the money managers, we have the next topic, which is, does the Indian economy really present a once in a lifetime opportunity for wealth creation in this so-called golden decade? Or are we in the midst of global geopolitical and macro risks and the thought of golden decade is just a wish? Ladies and gentlemen, we'll find answers to those questions with our eminent panelists who have the expertise. Let me introduce them to all of you. We have with us Mr. Hiren Ved, who is the co-founder and CIO of Alchemy Capital. He started his career by working with KR Choksey and Company, a sell-side firm known for its value investment approach, and eventually graduated to become the firm's head of research. He brings over 2 decades of experience in bottom-up stock picking, managing portfolios, and managing a high-performance investment team capable of delivering consistent, superior alpha. We extend a very warm welcome to Mr. Hiren Ved. We have with us Mr. Rajesh Kothari. He's the visionary founder and managing director of Alpha Accurate Advisors and the driving force behind making Alpha Accurate Advisors one of India's most respected, award-winning investment management firms. During the last 12 years, in fact, more than 12 years, Alpha Accurate PMS delivered 18% CAGR returns versus benchmark returns of 11%. And prior to Alpha Accurate Advisors, Mr. Rajesh Kothari was fund manager with DSP BlackRock Mutual Funds. He comes armed with a total of over 25 years of rich experience in the Indian capital market and received many awards for his consistent, outstanding performance. We extend a very warm welcome to Mr. Rajesh Kothari. We have with us Mr. Samir Arora, who is the main founder and fund manager at Helios Capital. From 1998 to 2003, he was the head of Asian emerging markets at Alliance Capital Management in Singapore. And in 2002, he was voted as the most astute equity investor in Singapore in a poll conducted by the Asset magazine. More recently, Helios Strategic Fund has been nominated for the Best India Fund by Eureka Hedge 10 times and has won the award 4 times. Helios Strategic Fund has also received the Asia Hedge Award 2018 for its long-term performance. We extend a very hearty welcome to Mr. Samir Arora. Ladies and gentlemen, this discussion will be incomplete without the able moderating of Mr. Naveen Chandramohan. Now, Mr. Naveen Chandramohan is in the acting capacity of the moderator, and he's the founder and principal fund manager at ITIS Capital. He's responsible for running the fund and takes all the portfolio and risk decisions at ITIS. Mr. Chandramohan has had an illustrious career spanning 15 years in the financial services sector, having worked across fund management, fundraising, and fundamental research. He began his financial services career with Lehman Brothers in Tokyo as a senior analyst in the capital markets trading desk. A very, very warm welcome to you, Mr. Naveen Chandramohan. And now the proceedings are in your hands. Please take it away, sir.
Thank you. Thank you so much for this, and thanks everyone for giving the time to come onto this panel. So, as was kindly highlighted, right, I think the context has already been set. As far as fund management is concerned, we would obviously like the next decade to be prominent for India. The context has been set for that. But through this aim, through the aim of this discussion, what I would like is to be brainstorming around certain views around what are the risks to this. And obviously, I would like a free-flowing discussion, so hopefully we can have that. So, US policy has always been an important one from a global framework, right? And being the home of capitalism, it's important to understand that efficient asset allocation begins there. At least that's what history has suggested. However, with US inflating the asset base by taking the balance sheet by almost 50% higher in the last 1.5 years. The deleveraging story is something that has not even begun, and it's in the early stages for that to happen. So the first question I would like to direct it to Samir out here to understand from his perspective, considering he does both global and India, he sits in Singapore and he's an active FII. How would you think about this risk, Samir? And do you really think the risk does exist for India on the ground? Samir, you're on mute, sorry.
Yeah. So thank you very much. So the big picture question, I guess, in simple terms, is whether the US slowdown or the US inflation or the US hiking, will that affect India negatively, let's say, in the next 1 or 2 years? So my view on this has been that we cannot do massive absolute performance if the rest of the world is doing badly. We don't make money only by enjoying somebody else's weakness or somebody else's failure. So the best background is if people or other countries are doing moderately well, and then we can do really well. So in today's context, I was very negative on even the Indian market going into January, and we had 25% cash in our long only funds. But today we are more or less fully invested with only 3-4% cash, because I think that the US as of now may have a mild recession. And a mild recession can be handled by India actually very well. Because the absolute growth of India then looks more attractive on a relative basis, which itself might not be very big, but on a relative basis, we are seeking growth. And second is that all these commodities and other things, if they fall because of a recession in the US and maybe in developed market, that also helps us. But if we keep fearing that the asset bubble in the US has to totally go away, and the balance sheet has to go back to 2 trillion, which it was maybe 10 years ago, that is too big a decision to be made so easily. Because it's like saying, one day the dollar will lose its strength and power, and some other currency will come. You can keep waiting for 5 years and 10 years, and that may not happen in a fashion that you can predict. So as of today, we would just celebrate the fact that a large part of the US correction is over, that the input that was responsible for this was high inflation, and the inputs going into that inflation, which is to do with commodity prices and shortages, and some of that have gone away. And therefore, X number of months later, which may be 4 to 6 months later, the inflation numbers there might look a little bit going down, and therefore the US Federal Reserve may back off. But for India, if that is the scenario, we can handle it quite reasonably well.
Thanks for that, Samir. I appreciate this. Hiren, I would like to take this conversation into you around how you think about not just recession, but also the balance sheet. And obviously, you've been a bottoms-up investor for over 20 years now. Does that even form into your framework, or how would you think about the world?
Well, I think, what's interesting about India is that India can be both a macro market and a micro market, right? I mean, recessions, inflation, all this is not very new. I think our economy and our companies have survived and thrived through such macro challenges in the past. And I see no reason why we cannot manage to grow despite what we are seeing in the external environment. Obviously, when you have tailwinds in the external environment, it is that much more easy to make money. When you have headwinds, obviously, things are not that easy, right? To the answer of, what will happen if the massive $8-9 trillion balance sheet is contracted? Well, nobody knows, because, we've never seen in the past this level of reflation of the global central bank balance sheets and what happens. But if you were to use the 2008-9 template, what happened was that the global balance sheets back then went from 2 trillion to 4 trillion. And they all started to then hike rates and shrink the balance sheet. And just about when they were trying to shrink the balance sheet, and they realized that the slowdown is coming back again. And then the liquidity stayed at that level. They could never really contract the balance sheet back to $2 trillion, right? And you can see it today. Look at China, what's happening, right? Every time growth slows down, you have to give another injection of liquidity. So I'm not a global macroeconomist, but I think that once you give a patient external glucose, right? Every time the glucose goes away, you have to give the next bottle of glucose. And I think the differentiation that I tell a lot of investors about India and most of the other global economies is that India is a natural growth market. You do not necessarily need to stimulate the economy to drive growth, which is the case with many other large economies today because of demographics, maybe because they've already reached a level of leverage, which is, most economies, developed economies, are 200 to 250% leverage to GDP. India is nowhere near that, right? So I think the benefit that India has got is that there is natural growth in this economy. You don't need to stimulate the economy necessarily. Yes, you need to have an enabling environment for things to happen and grow. And I think that as Samir rightly put it, in fact, in the past, if you go back and see, mild recessionary conditions have actually been very good for India to grow. Because, I think that you then don't face the kind of headwinds that you face when global economies are contracting at a very rapid pace. So I think we will be fine. And I think there is another last point that I would make is that I think over time, as India's macroeconomic situation has become more stable, we are less vulnerable than what we were in the past, right? So in relative terms, so let's say at $80 to $90 oil price, India's software exports now take care of the total oil import bill. That was never the case 10 years ago. So every time oil prices spiked to above $120, we had a macro problem on our hands. And I think today we are in a far better situation to manage some of these shocks. So I think I feel pretty okay about India now. And I think that whatever is on the table in terms of risks, whether we talk about inflation, and in my view, inflation is history for now, because you can't have two things at the same time. You can't be talking about recession and commodity prices going up and inflation hurting you. So you have to decide which template is relevant to you now. And I think inflation is no longer a template which is relevant. I think mild recessionary conditions, I think India is perfectly capable of managing that.
Thanks for that top-down view, Hiren. Rajesh, obviously you've been managing money over long periods of time, and you've been vocal about being a bottoms-up investor. Any thoughts that you would like to add to this around the macro framework before we go slightly further into detail? Rajesh, you're on mute again, please.
Yeah, hi Naveen. Thanks, and thanks PMSAIF for inviting me on this panel. Naveen, basically, just to add, what Samir and Hiren and by and large, I completely agree with their views. The important about Indian market, there are three important things about Indian market. The first, India is an entrepreneurial economy. So Indian entrepreneurs, you look at demonetization, which was one of the never thought of kind of an event in India in 2016, or you think about the pandemic 2020, or you think about 2008-9. You look at any period in last 30 years, Indian entrepreneurs have basically delivered strong and better earnings growth, number one. Number two, look at last 2 years. In last 2 years, the corporate India repaid roughly 180,000 crores of debt. The total debt reduction, excluding total free cash flow available, excluding IT sector and excluding Reliance, has been added by more than 180,000 crores. This is a time when there was a pandemic. This was a time when the entire world was basically shattering. And here, the corporate India repays 180,000 crores. That's a huge number, correct? So what I'm trying to say is that, one, we are an entrepreneurial economy. Second, very important is that we are moving towards a self-reliance. Just to add to what Hiren has already mentioned. So the cycles of economy, you can't skip the cycles. You can't avoid the cycle. It is like a business cycle. Every country, every economy goes through the cycles. But the shock absorbers are now much more stronger than what it used to be about 1 decade back. And third, the last but not least, it is not a temporary, very important. This is a structural, because by 2025, the average age of Indian is going to be 29 years. Our per capita income, which is about $1,900, the inflection point is $2,500. To put you in perspective, the China right now, it is probably about $11,000, correct? So from 1,900 to 2,500 to 10,000, the structural demand drivers, that itself is very, very important to look at. And that's why, as as Hiren has said, we are a natural market. So US, UK, Japan, and now China. So what China right now doing is what Japan has done in 1980, correct? But India doesn't have to worry about it, at least for next 1 decade. And that's why people say it's a golden decade. It might be platinum decade, correct? On a relative basis, the attractiveness of India, number one, and number two, the resilience of India. Look at the world. The US has moved from transitory inflation to very high inflation, which US citizen probably has not seen in the last 10 years, to now the fear of recession and stagflation. In last 9 months, we have seen the 3 episodes. It is like 3 decades in last 9 months, correct? So yes, the world has become more volatile. The markets have become more volatile. But Naveen, if you ask me finally how to make money, so looking at things from 40,000 feet, yes, we need to at least know what is happening. But when you look at the bottom-up approach, and when you look at from that perspective, finally how to make money, and equity markets are ahead of time. Look at last 40 years. Whenever economic growth finally reported degrowth in US, in last 40 years, US market that year was positive. Whether you look at 1980, whether you look at 2009, whether you look at 2020, the final print, whenever the economic growth final print comes negative, US market that year delivered positive returns. It means whatever right now we are talking in terms of the risk is actually probably we should have discussed probably 6 months back, probably 9 months back. Market is already corrected, correct? So if you ask me 1 year down the line, topic will be completely different, and that's what right now, what we need to discuss, that how we see the next 1 year down the line. Is it already priced in? Correct. And that's where I think the opportunity lies from investors to create wealth over medium to long term.
Sure. Thanks, Rajesh. And just to add on to what you said, I would like to obviously discuss 1 year down the line, but hopefully we try and move the discussion more towards the decade rather than what happens over 6 to 12 months. So we'll come back to what you just highlighted, some of the data points that you said, but I would like to first zoom out before we zoom in. Right. So thank you so much for that. I think it lays the macro picture fairly clear with how someone like a Samir looks at it, someone like a Hiren looks at it, and how some of the data points that you highlighted. Right. Now, if you go slightly inward now risk generally gets repriced from the bonds and the currency markets, right? Especially into a world of normalization, and equity is a follow-through asset class. That's how history has told you. Now, when China repriced itself, and obviously we love as Indians comparing our economy to the next China, they did it through currency stability. If you look at renminbi over the last 10 years of China's growth, it was actually stable. It did not depreciate itself. Now, however, both at the global level as well as at an Indian resident level, pretty much we have accepted to the fact that 4% depreciation per year is the norm. Do you continue to believe that India can behave as though we were in the 90s, where we continue to be worried about outflows when 20% of our GDP is in actual FX reserves? So this is a question I would like to start off with, Hiren, considering you brought up the oil deficit getting accounted for from the IT exports, Hiren.
See, I think, we cannot compare our FX strategy to what China is doing, right? I think if you look at the Indian FX strategy or the central bank who drives the currency strategy, I think by and large, what has saved India is a couple of things. One is that we have very little external debt, right? And that is a very important factor. Today, I think that our vulnerability to FX dislocations is probably not zero, but it is not very high as well, right? And I think if you look at the Indian currency this year, it's down 5-6%, but I think the average over the last few years is even below 4%, right? I think we are in a far better position. I think we can handle a 3-4% depreciation because there are compensating impact that happens, right? So a mildly weak currency is actually good for pricing power because all your import substitute products, the Indian industry becomes more competitive. Secondly, your exports become more competitive. And I think beyond that, I think what is of great opportunity to India today is the rewiring of global supply chains that we are seeing, right? And I think that, for example, the last time I even thought about textile companies was in the 90s. But now you suddenly find that because of some problem in the Xinjiang region in China, our textile companies have started to do well. And India lost competitiveness to other countries like Vietnam and Sri Lanka and Bangladesh, right? But I think with the new geopolitical and new supply chain realities that we are seeing, I think there is a great opportunity in India. And I think we need to keep our currency reasonably competitive because I look at growth as two engines of growth, right? One is the domestic engine, which we all know very well. But if you look at some of the best wealth creating sectors in India which have delivered, I think exports is a big area. I mean, had it not been for the generic pharma industry, which, if you were only to sell medicines in India, you would be limited to the per capita ability of Indian companies to buy or spend on healthcare. But you created multi-billion-dollar generic pharma companies like Sun and Cipla and Ranbaxy because there was a massive global opportunity and India created a massive competitive advantage. Or software exports. We've created a $200 billion annuity-based export engine, right? So I think that a mild, in the developing stages of our economy, a mildly depreciating rupee is actually very, very beneficial to India. So I don't look at it as a threat. In fact, I look at it as a great opportunity. And if you look at many developing economies which became developed, right? What was interesting is that each of these countries had created a globally competitive edge in at least one or two sectors. For example, Japan did it in electronics and automotive. The same model was copied by Korea, right? They created the Samsungs and the Hyundais of the world, which sold to the global markets. Taiwan did it in high-tech manufacturing and semiconductors. China did it in large volume exports. And I think India has done it in generic medicines, in two-wheelers, in auto components, in IT services. I think it is very important that in a country you have one or two or three sectors where the globe is your market, so that you can not only leverage domestic growth, but you can also leverage exports and global markets. So I think I'm happy if the currency depreciates mildly. Obviously, what you don't want is a massive depreciation like you've seen in Turkey or many of these Latin American countries, which sets you back by many, many years, right? But I think we are not in that situation at all in India.
Sure. So Hiren, just to summarize, obviously you are okay with the mild depreciation. I come from a different school of thought. I think we need to get stability into our currency first. All the countries that you beautifully highlighted have all grown with niche sectors. But if you look back in history, all of them have grown with the stability of currency. So it goes back, obviously I have slightly differing views here, but that's okay. The objective is to brainstorm rather than talk about just an individual view being right or wrong. So I'm just going to go into Rajesh now and see, do you actually think about the currency at all, Rajesh, in terms of your investing style? And considering we're talking about the decade out here, do you actually feel, because just to put it in perspective, right, a 3% depreciation, assume even it's a 2% depreciation, 80 should cross 100, right? And I don't think that's healthy, but I would be curious to get your view that matters more today.
I think, Naveen, what happens is it is a relative call, correct? I mean, it is just not a call on one currency against the other currency. It is a probably not multi factors which will decide where the currency will head into as we move into next 3, 5, 10 years. I don't know about next 1, 2 years. One is, of course, the commodity prices. Second is India's import. Third is India's export. And fourth is the relative performance of the entire world, be it Japan, be it China, be it US, and so on and so forth. Now, one thing is very important to highlight is that in FY22, India crossed $400 billion of exports. Our export is now 20% higher than pre-pandemic. Very important. Very, very important. 20% growth compared to pre-pandemic. 44% growth on FY21 and 20% growth compared to FY19. Our world share of India is right now just 1.6%. Of course, it is increased from 0.5% to 1.6%. If you look at our biggest partner is US, and our share to US is roughly 2.6%. It used to be 1% in 1990. So to decide whether currency, whatever the movement of currency, again, I go back to the driving forces which will decide the currency movement. And what is the driving force? The first most important force is cost competitiveness of Indian enterprise. And what will drive the cost competitiveness is two things. One, of course, cost of capital, which is reasonable right now. Of course, it may move up in the short term, but otherwise we don't have any major concerns. And second is the overall cost compared to China, compared to the entire world. And there, if you look at the labor cost, if you look at the power cost, and with the PLI efforts of the government, and India being a natural market and therefore results into the better economies of scale, I think India is right now very well positioned in terms of the cost competitiveness. The good news for all of us is that in FY22, this 20% growth over FY19 is not coming out of oil, is not coming out of jewelry, but it is coming out of the electronics exports, the chemical exports, the pharmaceutical exports, and so on and so forth. So it is a much more durable, it is a much more sustainable. And that's what basically I'm getting really very positive. Last week, I was talking with, not last week, 1 month back, when we had webinar with Cummins Managing Director, Ashwath Ram, and he was saying that globally, how Cummins Global is thinking. So there are only 3 plants in the world: Cummins North America, Cummins India, and Cummins China. And depending upon the cost competitiveness of each of that plant, they decide who will export to the world. Likewise, there are many companies which are now making India as an important hub for the global sourcing. And that's what will drive the competitiveness, and that's what will drive the strong exports. And then in turn will drive into the long-term probably currency stability or currency appreciation, which probably what you are looking at, that can currency stabilize. The good news again is that from the world investor, and probably Samir may agree with me, is that globally people assume that 2 to 3% depreciation is given. Means वो समझ के रखा है, वो assumption already है, तो वो factored है. The expectations are there. But can India become 0% depreciation and probably appreciation at the end of the decade? These are the structural drivers for happening that. So I don't want to forecast, but probably we are on right track.
Thanks, Rajesh. Samir, I came to you last for a very conscious reason, because your view matters here, right? Obviously, as an FII, you being one of the prominent ones, pretty much everyone talks about a 2 to 3% depreciation. The question is not whether you are also assuming the same. I would like to hear from you. What would you want in the sense? Do you really believe stability is more important or not really?
So first thing is, we don't expect 2 to 3%. We expect 4 to 5%, because that has been my history for the last 17 years. Since we started Helios in 2005, we've lost 4% per annum. So every time we report our return, not report, when we talk to some new investor, he says, is this in dollar or rupee? We say, yes, in dollar, because you are being reported in dollar. Then he gets a bit, backs off a little bit, because my one line has been that in the last 21 years, or since 2000 or 2001 or something, the Indian market, not fund managers who may have beaten the Indian market, but the Indian market in dollar terms has beaten Warren Buffett. So we have always said that it compensates. But my question in this regard and in every regard is, we are not interested in what should happen. but what will happen. In will happen today, I am going to predict that it's going to be zero and will strengthen. And you said we have 20% FX reserves in GDP. I mean, we don't have. It is all borrowed. We have not earned a single dollar. We are a current account and whatever account deficit. But I would like to go back to a more philosophical question. Why are we saying that this is a golden decade and what are the risks? First, how did we come up that it's a golden decade and why do we need it to be a golden decade? Because my thinking is that the guy who's investing in equities, whether he's a foreigner into a foreign fund or a PMS fellow into our PMS or whatever, he has to see his alternatives. His alternative is fixed income, some currency, gold, and for the foreigner, it is other markets. And we have to present a case that over the next few years, this will be better as it has been for whatever reason. If it turns out to be a golden decade, we will take it with both hands. But we are not going to make an investor invest on the basis that it is a golden decade. That means his hurdle is so high that if it is not a golden decade, he's not interested. The point is equities will outperform whatever else you do. And Indian markets broadly have done well compared to these emerging markets, Asian market, whatever you do. If it turns out to be a rocking decade, we will take it. But let's not take it to that level straight away. I can find you 5 negatives also. The point is, for an Indian domestic audience, sorry, you have no other opportunity. This is the opportunity. Equities be debt by an average of 5-6% per annum compared to your 10-year type debt. The reason why you get that 6% per annum higher is because you're not going to get it evenly. But you will get it is sort of cast in stone. We can give you 100 years data from other countries, and then we all have to outperform that market a little bit. But if you think it is not a golden decade, so I'm not interested, then it is not the right framing of the question.
Fair point, extremely fair point, Samir. I think end of the day, the micro is set for a fairly strong fundamental growth. The question is, what are the risks, right? What can go wrong and what can be?
So quickly coming back on the currency. So I don't think that we are at least ever thinking that we will make money off currency, as in that the rupee will strengthen. If it does so, okay. But no way that in 10-year time, I'm going to project today. First of all, we are all micro guys. The macro we are willing to do while it is going on. So as I say, if you had asked me on 26th of Feb or whatever, 23rd of Feb, what do you think of the Ukraine war? I'll say, I have no idea. These things don't happen in the end. It's a low probability, high impact event. But on the day it happens, I will not say, you look at the previous war episodes, these things all get taken. I'll say, sorry, we are in the middle of it. I will back off. It's the same thing with inflation. If you tell me 1 year ago, will the inflation in US increase? I'll say, don't bother me. But when the Federal Reserve or the RBI comes in and there's a surprise hike and somebody says, what do you think of inflation? I won't say, no, I don't look at inflation. I am in the middle of it. I will look at it. Because it's like saying that over 100-year period, wars don't matter. Because if you saw World War II, it was 1 dot and World War I was 1 dot. And today some war started in India and we say, no, we don't look at war. Can't you see the history? Then we have to look at it for the next. So when this currency thing happens, then we will think about it. Right now, we are going with anybody in the foreign world asks me, what about currency? I said, yeah, 4%. Don't bother me. You will get net of 4%. You'll make enough money. That's a simple answer. So who can prove these things beyond a point?
Sure, perfect. Thank you so much, Samir. And since you brought up the micro aspect as well, so we'll just go into one particular sector, which maybe as fund managers, each of you could be underinvested in, or maybe don't look at it all. The question is, would you look at it? So something interesting has been happening in the global space, right? China has been buying up hard assets for a good part of 2-3 years, be it natural resources or otherwise. One of the world's best capital allocators, at least everyone in India looks up to Warren Buffett, has been buying Occidental. So the question is, in India, most of the hard assets have had policy intervention. So, and it's not capitalistic in nature. So do you see India or the world going into a multi-year commodity cycle upswing, and would you react to that into each of your individual portfolios? Rajesh, can we start off with you on that?
Well, Naveen, I forgot the name of the musician, the great musician from Europe, and he said, you should know what notes you should not play. Correct. Commodity to us is like that. We don't have competence to predict the commodity prices. Period. Correct. To predict commodity prices, it is just not driven by demand and supply. It is driven by the global tariffs. It is driven by geopolitical. It is driven by cartels and many more such things. What we see is that the companies what we are buying, the companies what we are buying in our portfolio, do they have a pricing power if the commodity price goes up? Not for 1 quarter, 2 quarters, but over a period of 1 year, 2 year, 3 years. And if answer to that question is yes, then we buy that company. Number one. Number two, whether the company has a sufficient balance sheet. If the commodity price goes up 40%, whether they remain cost competitiveness with the right balance sheet. All my portfolio companies are 90% debt free or maybe less than debt equity 1:1. So in the high interest, because high commodity prices means high inflation means high interest rates. That's another second variable comes by default into the picture. That's what basically matters. So beyond a point, I'm sorry if I disappoint you, but cut it very short. We don't try to predict. We don't even waste our 1% of time predicting commodity prices. Of course, we spend a lot of time in predicting the resilience of our portfolio companies, that whether they are going to continue to enjoy that pricing power or not.
Thanks for that, Rajesh. And you're not disappointing me. This is an open-ended question, just to understand how you brainstorm and how you think about risk. So I am not happy if you say a yes. Neither am I sad if you say a no. So, Samir, coming back to you, any thoughts you would like to add to this?
So broadly, we don't buy commodity stocks. Once in a while, we have bought maybe one stock, some 3% type thing, just to cover ourselves once in a while. But broadly speaking, the reason I don't buy commodity stocks is then when I would meet these commodity company representatives in the last, 10, 20 years, normally when we meet some company, we ask them how they are doing and what is happening. For commodity companies, they ask us what we think of the world growth and what is happening. Because my general view is that the commodity guys don't know what is happening tomorrow, and the IT guys don't know what is happening in 6 months. The IT guys have 3 month visibility, and the commodity guys have 2 day visibility. So therefore, we have seen it even now that how these prices have fallen, and 2 days before the price falls, the government is putting, whatever excess profit charges, and the next day the oil price is gone and the margins have fallen and refining. So nobody knows these things, but we are flexible in the sense that my job at the first level is to beat an index. Because I think if I beat the index, I mostly beat everybody, because many people don't beat index and then the index beats other things. So when I'm beating the index, my job is that I have 100 rupees and I must use it to the best of my ability to beat this bloody index. Now, let us say that one sector is bugging me every morning because it goes up and I don't have it. And it is 5-10% of the index. And there is some story for that also. Just like we say we don't understand commodity, so we don't buy it. We could also say we buy commodity because we don't understand it. So point is, if I buy 3-5% of some stock and every day it stops bugging me, with the balance 95%, I can add as much value instead of wasting every day 1 hour saying, shit, I should have had that bloody stock, because there is some logic to it. There is some China angle. Somebody has shut his factory down. There's a fire somewhere. And I also know it. But I say, I don't buy it. So we are not like that. We will buy 1 or 2 stocks. We have always these Hindalco, Tata Steel when needed. Okay, not now. If really it's bugging our mind, you buy 3% and let them go to hell, and you deal with the balance 94% the same. It is still massive value added, because you have to understand the game in some sense. It is not to satisfy a purist. For example, I always said on my TV, if you see, that I never buy PSUs. Actually, my whole life returns have come from betting against PSUs. But for the last 2 years, our second largest holding is State Bank of India. Because sometimes you override these simple points for whatever reason. Sometimes it's very cheap. Sometimes there is some story to it which you can understand, or sometimes there's a story to it which you feel that's fair. It may not, but you cover your bases a little bit. Still, there is a lot of flexibility to add.
Got it, Samir. So just to summarize, two similar views but different outcomes, right?
A
Basically,
little bit
I don't
different.
understand commodities and not touching it. You are like, I don't understand commodities, but at the same time,
Once in a while, I may touch it. Once in a while, I
regret
may touch it.
minimization is what you use, which is very, very fair. Hiren, coming to you, right? Because you have been completely bottoms up all through as well. Would you post much merit into this commodity upcycle that we could go into, or you're not going to rack your brains around?
No, I think, okay. So let me first, I think we all try to skirt this issue by saying that I cannot predict commodity prices. Well, I think a lot of things that I invest in, I don't think I can predict a lot of things as well, right? So when I buy a specialty chemical company, frankly speaking, I do not know whether tomorrow the price of X or Y or Z specialty chemical is going to go up or go down. You look at the overall opportunity and you use a basic probability to say that, yes, I think if there is a basket of commodities in a specialty chemical company, I think broadly speaking, they will grow at an X rate they should be able to protect Y margin, and therefore I will make money in that. I think, yes, I think what happens when you talk about commodities is that, yes, you have to decide how much volatility you want to bring in your portfolio, right? Just because it's commodities doesn't mean that you won't make money, right? And just as Samir said, naturally speaking, we would not invest in commodities. But have I invested in commodities in the last 25 years that I've been managing money? The answer is yes. And I'll give you an example. I think it was in 2003. We were coming out of this very bad manufacturing recession post the Asian crisis, and most of the manufacturing companies and commodity companies were bashed out of shape. And I went to attend the analyst meet of Tata Steel, which they had kept in Taj. And at that time, Mr. Muthuraman was the MD. And I think he did a brilliant job of making Tata Steel one of the most competitive steel companies in the world. And believe you me, when I went there was a huge ballroom in Taj, and there were hardly 5 or 6 analysts or 10 analysts, I think, who were interested in knowing the story of Muthuraman and, all the good work he had made. And I think, if I remember very well, the stock price was 150. And, at that time, I never used to think so much ki, ye cyclical hai, nahi hai. But one thing really told me that, yes, I think there is a lot of good work that Mr. Muthuraman has done. The cycle is down and out, and nobody is interested in this company, right? And we invested in Tata Steel, and we held it for 2.5 or 3 years, and we finally sold it at 400, 450. And after that, we've never looked at it again until recently, right? So, it's in the investing game, you should never say never, right? Yeah, if you don't understand a particular cycle, and you don't have to, just because I bought Tata Steel and made money on it, doesn't mean that in every cycle I have to prove myself that, how is it that in this cycle you didn't, take advantage of this. Fair, I mean, you were distracted. There were other opportunities that you had, so you didn't spend too much time. The second thing, the way I look at it, is that when you look at some of these big predictions that are made, like a commodity super cycle, a resource super cycle, right? If you can understand, if you genuinely believe in that hypothesis, there are very, very many ways you can play that, right? So you look at the entire cycle and you say where in the cycle you want to play. So I can play a great resources cycle. For example, we have invested in an engineering company which makes 25% EBITDA margins and has a 25% plus ROCE, and will benefit because there is more mining and resources which is happening, and they have global leadership in the business. And we think that now the volume growth will happen. So yes, I mean, that big context of a large super cycle in commodities, I am able to find a good consumables company which will make money, fine, I will invest in it, right? But as Samir said, am I going to put a disproportionate amount of my time and portfolio in trying to figure this out. I think the beauty of the Indian market is you have got so many other alternatives. And, if I'm going to be second guessing what's going to happen every day in the morning, whether China stimulated the economy and therefore, aluminum and steel prices are going to go up, I'm not going to spend my disproportionate time. But as I said, in the investing world, never say never. Keep an open mind. If you don't understand something, if you can't follow something, you step aside, you do what you understand.
But as I say, in Google, which is our number one holding offshore, we have no idea how it works. We don't know how the secret, but we say, okay, theek hoga. So you many times buy stocks which you don't exactly understand precisely कि उसका underlying model क्या है, Coke का formula नहीं पता. By the way, I have one more favorite on this because I for many years did not buy Titan on the basis that its revenue line is commodity.
Yes,
because
gold.
It doesn't get absolute amount. It gets percentage of the price
of gold.
So effectively, it's the revenue line is a commodity line. Then later on, I said, "Chodo itni analysis nahi karni chahiye kahi bari." But these things matter. But in the end, you have to take.
No, you are absolutely right, Samir bhai, that the making charges are a percentage of the gold prices, right?
Exactly.
So you could argue that this is a commodity.
I used to argue. For 1 or 2 years, I argued. Then I said, I'm not arguing.
Because, Samir ji, because उसमें क्या है ना कि typically in commodity, the volatility of the ROE and ROE compared to the consumable, of course, and that's basically what makes all of us probably little bit against that basket.
No, I agree with you. The only thing is we say, because अभी आजकल होता है कि high peak देना चाहिए. हम कहते हैं पहले से ही वो कंपनी स्टील वाली 6 पे थी और वो 30 पे था. अब 30 को 90 मत बोलो कि वो बेटर कंपनी है. उसके लिए पहले 30 पहुंच गया था वो दूसरे के 6 के बदले.
सही बात.
Considering we have only 10 more minutes, right, I would like to squeeze in 2 more questions with each of you. So if we can keep it short, it'll be extremely beneficial. Obviously, the micro has been laid out. It's extremely bullish. And I can understand the context that each of you are coming from. If I was to play devil's advocate with this, and considering the fact that we are a consumption-driven economy, but you look at the number of taxpayers on the ground, it's roughly around 5 crores today. The number of active DMATs is around 1 crore. In spite of COVID, digitization, financialization, the theme that we keep talking about. Do you view this growth as still tepid in nature, or is it just the beginning of more to come? And considering... Yes, sir. Please go ahead.
I want to start because I want to make it a bit of a controversy so that the thing is we have a large number of taxpayers. We don't have, people say that only 5 crore taxpayers are there out of 130 crores. It is very, very high. Number one reason is that separately, some 60-70% people live in rural. And there, if you see our average income is, you said $2,000. Our starting tax rate is higher than $2,000. Unlike, say, in Singapore, where the average income, average per GDP is $55,000 and the tax rate is at $15,000-20,000. So it is almost by definition that when you're starting income level at which a tax will be charged is some 8,000-9,000 or whatever we have, 5 lakh rupees. So it's 7,000 or average income is 2,000. Secondly, we just said we have the youngest population. So those people are out of tax. We have women who don't work. And an individual who's selling his pan or a fellow who's driving a 3-wheeler, he's allowed, according to me, philosophically to say that his wife is his marketing director. So in a sense, it's at a family level that this tax is charged. The number of taxpayers is not less, even though people keep saying it. But the thing is, we also don't say that we don't believe in a billion consumer stories. So broadly, for any consumer story, we want Mota Mati that the denominator be 30 to 40 crores. We are not counting exactly how many, but it should look under-penetrated in a 30 crore type number, not at a 1.4 billion number. That's the case.
Fair point, Samir. Hiren, Rajesh, any of you would like to take over from there?
I'll let Rajesh go first.
No, I think, beyond the point, as I said, there is not much, what I would say, evaluation or brainstorming what we do internally, on such numbers. Because, see, basically one needs to look at household. So on an average, if you assume 4 people per home, correct? So 130, 140, whatever that number is, you basically get 25 to 30 million households. ना उसमें poverty line वाले सब निकाल दो तो और minus हो जाएंगे, and so on and so forth.
I mean, free food was given to 80 crore people according to the newspapers. 80, so those 80 crore mostly are not tax.
Correct.
So income ही नहीं है तो tax कहाँ से देना चाहिए?
Correct. And if you look at Manekra report also, the minimum जो free में वो जो जाता है वो भी इतना बड़ा number है. So I think important is not this taxpayer or number of demand. Important, I think, is very important, and I don't know whether we touch upon, we have limited time, is the that Aadhaar card driven financial inclusion. That can be much bigger. That what is it? JAM, JAM, and that's basically huge financial inclusion. That financial inclusion will result into more and more people coming into the overall economy, reported economy number. And as that happens, the entire consumption, loan, the total the credit card spend, total digital spend, total e-commerce market, and so on and so forth. That's why if you look at the digital economy, which is roughly about say 10% of the economy, is expected to become 22%, 25% in the next 3 years. From 10% to 22% next 3 years. That is because of the entire digitalization of this world. And I think that's where probably we are focusing more when we look at the micros.
Got it. And Hiren, rather than you answer this, I would like to pose the next question to you, which maybe viewers are more interested to hear. Right? I think broad base effect part of it, Samir has already covered. So today, as a portfolio manager yourself, right, be it a domestic or a FII, pretty much everyone has an overweight on banking for obvious reasons. So leave banking aside. Considering the fact that we're not going to be discussing stocks, are there pockets of opportunity that you view that you would want to own? More from a top-down perspective. If you would like to talk bottom-up, perfect. But if you want to keep it to top-down, your views would be more important here.
See, I think, the key in a portfolio is to have we are not, so first of all, we are not benchmark driven. So we don't stress too much about the fact that, financials is 35% of the benchmark and therefore we are overweight or underweight. I think for years together, we've only owned 2 financials and we continue to own 2 financials, whether the benchmark went from 40 to 35 or will go back again, right? I think that in the current context, if you are asking me where do we see opportunities, I mean, obviously we have financials, we have a reasonable exposure to IT, but I think in the current context, I think we like a lot of the consumer discretionary companies where I think consumption is coming back very, very strongly. So for example, in our top 5 holdings, we have a large liquor company, which we've been holding for many years, but we've added. And I think the auto sector, after many years of being sideways, I think we think that there is money to be made. Finally, we are in a very unique situation where, demand is greater than supply. And we keep crying about supply chain issues in automotive. But if you look at the margins of most automotive companies, they've premiumized their models and they are selling the more profitable models. And there is no more discounts in the industry. And I think as some of these supply chain issues get resolved, you will also see volume growth, right? So I think without getting into specifics, there is one area where we are definitely and purposefully overweight is in all things which are consumer discretionary, right? Because we think that there, the next 2 years, we will see a couple of years, we will see a very strong rebound in demand. What we are avoiding so far, or you can call it underweight or whatever, and what I do see in the economy is that the purchasing power at the bottom of the pyramid has really got impacted in the last 2 years because of COVID, right? And then on top of that, a little bit of inflation. And I think that you will require at least another 18, 24 months for those people to have a full 365-day working, year to rebuild their earnings at the lower end. So I think most of our consumer discretionary is in consumers who have not seen a significant impact, in fact, have seen a better wealth effect in the last 2 years, right? And so things like autos and liquor and, QSR and stuff like that is the area, apart from the usual, financials and IT services, which we always continue to like, is where we are significantly overweight and we see a lot of opportunities there.
Thanks a lot, Hiren. Rajesh, would you like to take over from your perspective?
I think if you ask me, because there are many, so we are well diversified portfolio. We believe in more diversification spread across 14, 15, 16 sectors. But if you ask me, where has been the major change from our side in last 1.5 years or so, capital goods is one theme we believe which will do extremely well. Countries just coming out of the low capital formation. The bank balance sheet is cleaned up. The credit cost has come down. If you look at 2003 to 2008, the capital goods index delivered 15 times return. Index went up 15 times compared to Nifty went up 5 times. So we believe, I think we are in the early cycle of capital, capex. So roughly, if you ask me, in next 3 years, total capex is roughly estimated to about 7,200 billion, and that is 134% growth compared to last 3 years. So that's one theme on which incremental basis we are becoming more bullish. Number two, specialty chemical. I think it is just not 1-2 year theme, but it is now moving to 3, 4, 5 year theme. So it is becoming a lot more structural. And I'm using the word specialty, not chemical industry, only specialty chemical industry. They have been hit hard probably in last 2 years because the commodity chemical prices went up, and therefore they might be natural beneficiary, apart from the, of course, the good R&D and patents and so on and so forth. Third important sector is consumer discretionary. But what we do internally is that we do further segmentization. So for example, real estate, we like it, but we don't generally buy real estate company, but we about the building material space. I think that space will do reasonably well over next 2-3 years. So the plywood companies, the pipe companies, the tiles companies, and the wire and cable companies, autos and auto ancillaries, and of course, then the retail space of the consumer side. These are the 3 sectors on which we have been reasonably bullish. The sectors on which we are currently underweight: metal, we have 0 exposure. I think pharma, we are significantly underweight. I think next at least 4 quarters, probably sector may continue to see some pain. The IT, we are underweight since last probably 1 quarter or so. So these are the sectors where probably we are underweight, and the sectors I already talked where we are probably more bullish.
Thanks, Rajesh. Over to you, Samir.
Well, we only invest in the same 3 themes nearly all our life, which is financials, consumer, and IT, which now has become over the last few years IT, pharma, specialty chemicals. So broadly, we say we always invest here, but 90% only comes here. 10% we will have some reliance, something else here or there, which neatly we will not be able to fit in any of these. But these are the 3 themes. Actually, these are not only India themes or current themes. If you look at the Forbes list of billionaires, which means that they have created wealth over the years, most of them will come from either consumer, IT, or tech, and financials. Of course, the financials are mostly the fund managers. But broadly, these are the bankers, there are not many who are themselves big in the world at least. But broadly, these are the global themes, and then once in a while, something new will happen or not happen. But because we also short, so currently we are short the very, very highest quality companies. And have been for 1 year or so.
Thanks a lot, Samir. Appreciate this. I think we've just squeezed in everything in the last minute, so I'm going to end it out here and ask the anchor to take it over. Thank you so much for your time.
Thank you.
Thank you. Thank you very much, Mr. Chandramohan, for that methodical steering of this wonderful session. Thank you for bringing the best out of the panel. I'd like to thank the eminent panelists very quickly. Thank you very much, Mr. Hiren Ved. Thank you, Mr. Rajesh Kothari. And thank you, Mr. Samir Arora.